The two investment guys join us now. And Grant, let's get right into this correction that happened. We were expecting it in October. It did happen, but it doesn't seem now like it happened. I mean, the stock markets are back to normal.
Yeah, you know, Tim, a lot of the things that we were worried about back then, we're still worried about today. For instance, you know, China growth slowing, that was happening then, it's still happening. There's a little bit of central bank stimulus talk now. Same with the Eurozone and recession.
The
Ukraine and Russia and the Middle East strife, and you know, these things seem to never end. I think part of it was everyone was calling for a correction. The sentiment led us there. We got it. The S&P was up about 12% on the year pre-correction. Now we've got this behind us, and we're up 13% on the S&P year-to-date number. So really, what's changed? The sentiment's changed. That's about it.
Yeah, Kris, confidence is coming back to the markets. Why are investors, I guess, perhaps sitting on a lot of cash beforehand are now getting into the market?
Yeah, absolutely. That correction provided an opportunity for people to get some cash put to work. We saw that happen, and that's why we saw such a quick rebound. I think corporate earnings is the thing that really has been driving sentiment, and corporate earnings have been pretty much spot on, better than 70% of companies beating analyst estimates. We're seeing top-line revenue growth, profitability growth, and that's really what investors want to see, and that's what drives share prices.
Grant, let's talk about interest rates in the market, because that always is a bad sign for stock markets. And the Organization for Economic Cooperation and Development is suggesting that Canada may start increasing interest rates in May. The Bank of Canada says no, more like 2016. Now, what do you think that means for investors, and will it even happen?
I'm skeptical whether it happens, and we always try and pin a specific date on a lot of these events. I think their track record is less than stellar in terms of accuracy and where they're coming from. The fear in the markets is a rise in interest rates is harmful for equity markets. But a lot of things have to consistently happen and improve to get us there. And I think the trend is decent. It's slow growth trend, but you know, we're nowhere near any inflationary pressures here, and that's the primary driver here of interest rates going up.
And Kris, the OECD also suggests that exporting nations such as Canada shouldn't be relying on the U.S. growth in consumer demand, because it's quite flat at the moment.
Mm-hmm. Well, you know, if we look at one of the things that hasn't recovered from the recent corrections of price of oil. So gasoline prices in the U.S. fell from about $4 a gallon at their peak to now down closer to $3 a gallon. And for every penny drop in the price of gasoline at the pumps, it adds $1 billion into consumer pockets. So I would say there's a lot of additional discretionary cash there that can be put to work by consumers in a variety of different ways. We're seeing it show up now in some of the retailers' numbers.
Yeah, so that's good news for the consumer. And so if our viewers want to get a hold of you guys?
Yeah, our website's twoinvestmentguys.com.